In this week's update, US guidance remains strong. All main US indices are at new highs. How to think about this market, and we'll visit the Bitcoin chart as well. My name is Garry Davis, and as always, this is general advice in this video, and please remember to like and subscribe to the video. All right, let's start with some overall market perspective, because it's been another very positive week. And when I think about, the sorts of non-mechanical aspects to trading and investing, it's really obvious that the most valuable asset that we can have is an open mind. And I've talked about this many times, because things in the world are changing so quickly that if we are stuck with the way that we think things should be or the way things used to be, then we're going to be left a long way behind. And how many times, just think back since the GFC, when money printing really took off, how many times has the market confounded us since that time? How many times has it set new highs that would appear to have been virtually impossible? Even think back just to last year with the crash that went along with the start of the COVID pandemic, and how much the market has bounced back. It seemed impossible at the time. And also the number of new assets, new asset classes that we can play in these days. Bitcoin is really getting some motoring behind it now. Marijuana stocks are gaining momentum in the States. There's a new class of assets in the States called special access vehicles, where entities or entrepreneurs raise capital. They might raise $500 million, but with no business. They're just raising capital on the assumption that they'll go and buy a business at some point in the future. So investors are putting their money into these special acquisition vehicles on the trust that the entrepreneur that's floating them will find a good business. That concerns me a little bit, because it seems a little bit of a sign of excess exuberance. But nevertheless, some of these special access vehicles are bringing to market some very exciting technologies, particularly in the 3D printing area is one very exciting area. So who knows? Maybe this is just all part of the new world of finance. We shouldn't shut it out. We should keep an open mind to it. And it's not what we buy that's the issue. It's really how we buy it and how we manage it that counts as to whether we get a good return from that or not. Markets are forward-looking, always have been, always will be, and there is no question that despite what's going on with COVID and all the restrictions, that global growth is occurring, and reflation is occurring, all the stimulus. In fact, it would be amazing if we weren't getting a level of inflationary pressure, and we're certainly seeing that now. So reflation is happening, and in the early stages, the first couple of years, generally a reflating environment is generally very good for stocks. As you get further on and inflation starts to break out, and then central banks have to jump on the interest rate pedal, then it's generally pretty positive for equities, and that's where we're at the moment. The reality is, in America, with earnings season winding up, that earnings are rising very nicely. The level of earnings beats on both the revenue line and the net profit line are rising. It was something close to 80% on a beating on earnings, which is a very high level. And even more meaningful is that around 40% of S&P 500 CEOs in the last couple of weeks have actually raised guidance. Now, I've raised this point before, that they don't need to raise guidance in an environment where share prices are rising very quickly. They don't need to pump share prices up. Prices are going up anyway. And so they stick their neck out for what? Other than the fact that they are convinced that earnings are rising, and therefore they're providing positive guidance. So that's another really positive sign that this is not just a speculative bubble that we've got going on here. This is a rally that's based on, okay, some parts of it might be getting a bit excessively valued, but there's no question that earnings are rising. So it's based on a good solid footing. And at the end of the day, this is what drives markets. It's rising earnings and global growth. That's what equity markets respond to in the long term. So moving away from the conventional way of thinking, having a broadly diversified portfolio across all sectors of the market, and all those sorts of things, owning predominantly top 100 stocks. You've got to move away from that level of conventional thinking, because that's where a lot of the risks actually lie, in those stocks that are being disrupted, the stocks that are being left behind. And just gaining clarity on what's right for you has never been more vital. So there are tremendous profits to be made, but you've got to sit down and get clear about how you're going to go about it. It's not that difficult. Most people seem to resist wanting to do it, but it is the most important thing that you need to do. And just think about, again, all the things that have happened since the GFC. If you'd applied normal, conventional, logical thinking, these set of circumstances therefore should lead to this outcome, then what would that have cost you in the last decade? It would have been absolutely enormous. So just bear those thoughts in mind. All right, before we go to the American stocks, just so that I don't forget it, we'll just have a check-in on the Bitcoin price. So Bitcoin is obviously trading 7 days a week. So when I last reviewed it, this was what the chart would have looked like. It would have finished there. And you can see that at the time I was saying, well, because we got to a period of excess here on the 8th of January, we were way above the 20-day moving average, this green line, and we then got a sharp reversal. And then we were bouncing around a bit. I felt that it was highly likely that we would then go into a period of consolidation. Well, we didn't get that at all. We just busted out. And you can see the increase in volume that came with that breakout. So it's been an incredible week for Bitcoin that finished at $47,500. Now, I'm not sure what these volumes are down here, because they're massive numbers. I don't know whether they're numbers of Bitcoin or partial Bitcoins or trades. I have no idea what they are. But just look at the relativity. Look at the volume of activity now compared to the volume of activity back here. And it's at, back here, this volume was related to Bitcoin when it was $10,000. Now this volume, which is 5-10 times bigger, applies when Bitcoin is 4 to 5 times more expensive. So it just gives you an idea of the way that the volume of activity and the dollar value of activity is just absolutely soaring. So there's no question that that Bitcoin has got an enormous head of steam. Now, buying it now, of course, from a technical point of view, is hardly recommended. You really need to focus on buying dips. It's incredibly volatile. It makes it very difficult to trade on a shorter term basis. I think a lot of people seem to be approaching Bitcoin as a buy and hold asset. And I don't know whether that's the right way to go or not, but there's no question that that Bitcoin is rapidly heading towards mainstream. Okay, enough on Bitcoin. Turning to American stocks, the S&P rose 1% across the week. Most of the indices are quite overbought in the short term, but of course that doesn't mean they need to turn down. They can stay overbought for many, many months. The other point I'd make, though, that's really important is that the rally is very broadly based. This is not just a rally of a few technology majors. This is across the board. Small caps are doing brilliantly well, and also it's the same globally. Global indices are doing very well. Now the US dollar slipped back a little bit, so the limp bounce that I talked about last week was just that, was pretty limp. And the US dollar slipped back again. The 10-year yield, though, is headed up again. We're now to 1.21. So whilst governments and central banks might have, effectively zero interest rates, it doesn't stop the actual interest rate market moving higher, and we're seeing that. So clearly, this is the global reflation trade having its effect on the real bond markets. So let's just take a look at some stocks or the indices on a relative basis. So we'll start with this is the energy sector, the overall energy sector in America. Now the key thing to look at is it outperforming the S&P or not? Because if it's not outperforming the S&P, then it's not drawing in an outsized flow of funds, and you can see that it's pretty much keeping pace with the S&P. Yes, it's going up, but only as far as the broad general market goes. Let's look at healthcare. Healthcare index is going up, but again, only just at the rate. In fact, maybe even at the broad index level, slightly below the S&P. So we need to drill down into that because there are many subsectors or industry groups within healthcare. So let's go and look at biotechnology as one example. You can see it's a much stronger trend if we zero in on biotechnology. And this gets to a point that I'll make fairly soon. And you can see we're really going sideways still, but maybe just starting to turn up a little in biotechnology. But let's now look at communication services. There's no question this is a really strong sector of the market, and look at the performance or the outperformance in recent weeks relative to the S&P. This has really taken off much quicker than the S&P. So there's a lot of funds going into that area. Why wouldn't you go in that area? Why would you buy into some other area that's not moving? Technology, similarly, the broad technology index is about on par with the S&P, but technology covers many industry groups. Let's look at some of the strongest ones. This computer hardware. Rising, yes, all the indices are all lined up. The 200-day is rising, the 50's above it, the 20's above that, and the price is above all of them. So that's a very positive trend. But it's only barely outperforming the S&P, so we can probably do better than that. So let's now look at the internet index, and you can see really taken off in the last few weeks. So this is an area of great strength. This is where the earnings growth is, and this is where the funds are flowing into this sector. So why wouldn't you do that? And just to round it out, semiconductors enormously strong. They've been rising relative to the S&P for a long period of time. In fact, all the way back from the crash last year, and have done enormously well. In fact, the semiconductor index has more than doubled since March of last year. And finally, just to wrap it up, this is software and computer services. So again, a very strong area of the market. So why would you go and invest your money across the whole broad market? Why wouldn't you just zero in on the sectors that are doing best? And then within these subgroups, of course, the next step is then to find the strongest stocks. But I'll come back to that point. Now, the final point on American stocks, I'll go back and look at the S&P in just a minute, is that the VIX has also now dipped. You remember it was only a couple of weeks ago that the VIX got up to about 37, 38, and I made the point that it was likely that was going to peak out pretty soon because the VIX hardly spends any time above 40, and so therefore we were likely to be somewhere around the top in the VIX, and therefore the short-term low in the market, and that's how it played out. And we've now got the VIX down under 20 again. So we'll take a look at the S&P. New all-time highs for the S&P. Looks very impressive. We are overbought. But look, it's only been a week. It was only the end of January where we got a 3 or 4 day pullback, and we've advanced again. So we'll get another pullback, possibly before this month is out. But look, who knows? But at the moment, it's an opportunity. Buying the dips is an opportunity for a good solid entry in the right sort of areas. Now, if we look at the Russell 2000, so for small caps, there's no denying the strength of that trend. This is a very broad-based rally in America. Turning now to the currencies, this is the US dollar. So this was the limp bounce that I talked about last week, and it certainly came off the boil in the last few days. The Australian dollar, of course, has done pretty much the mirror image. and we finished the week at just over 77 cents. So 77.24 was where we finished, but I'm just getting the sense with the Australian dollar, just purely from a technical point of view, that the uptrend might be sort of struggling a little bit, and that normally happens as soon as people start locking in 80 cents plus as being a given. That's generally pretty close to the end of the trend, and that was happening a few weeks ago. People were starting to say, well, the US dollar is breaking down, therefore the Australian dollar is going to go back over 80 cents. And maybe even to parity. I think that's a bit of a stretch at this stage. Now, our index slipped about 0.5%. But look, as I've been saying now for probably 2 or 3 years, the best risk-adjusted return in the Australian market is in high-growth small caps that have been bought with a very clear game plan about how you buy in, how you take partial profit, how you set your stop losses if you're more of a shorter term trader. There are many ways to go about it. You've just got to get clear on the way that's suitable for you. And that is where the best risk adjusted returns are. It's not in the majority of the top 100. In fact, some of them I think are absolute value traps. Turning now to precious metals, gold was up $11 to $18.25. And given that we've been in the strongest seasonal time of the year from November through to February, the performance of the sector has been disappointing, to say the least. And I'm a little anxious about what happens now, because from March through to June is one of the weaker periods of the year for precious metals. Now, seasonality doesn't always work out. Different things happen in different years. They're only looking at long-term averages, what happens most of the time. But certainly the seasonality in precious metals is related to the buying patterns around gold. And so it has some validity. So it's hard to be bullish about the next few months until we get into the middle of the year for the precious metals sector. Now, silver also steadied. We had quite a sharp pullback from that attempted short squeeze, which I think to a degree was a bit of a media-inspired event. So it came back, got back into the 26s, but it steadied and went up a little bit, finishing at 27.38. But the outlook for silver is really good fundamentally, and the big picture chart is still reasonably positive. Now, when we zero in on precious metal stocks, the earnings are rising, across the board. And with rising earnings, and now the fact that gold stocks and GDX have languished now for some time, it now offers a lower risk entry. Now, I don't know if prices are going to go up. All I'm saying is that on a relative basis, GDX is now below the 200-day moving average, and that generally that has proven to be a fairly good entry point. However, the caveats above apply, and that is that we've not been able to gain traction during the strongest seasonal time of the year. We're now coming into the weakest seasonal time of the year. So I wouldn't be expecting too much from the precious metals sector. Now, of course, in Australia, we've got the situation where there is money flooding into stocks that are drilling for gold, and those stocks are being well supported. So, it's still possible to trade profitably, but if you want to invest for the longer term in gold stocks, now is probably a reasonable entry point, but I can't promise what might unfold in terms of a return in the next 3 to 6 months. So let's take a look at some charts in that area. So we'll start with silver. So you notice the silver chart. I think the key thing here is to look at the moving averages. They're all lined up quite nicely, the 200, the 50 and the 20, and the price of silver is above the 20. So we still have a very positive orientation there for silver, and the big picture is that silver's heading higher. This is gold though on a daily chart, and you can see that the moving averages are aligned quite differently, and the price is actually below it. So gold is definitely underperforming silver. And looked at on a weekly chart, you can see we had this big surge that occurred in July and August of last year, and then since then it's just been a big consolidation period. And finally GDX. So we've now got the 50-day moving average is actually cut down below the 200. The price has been below it for so long now, it's actually dragged that average down. So from a relativity point of view, this is a lower risk entry point for gold stocks, but it doesn't mean that they're going to go up. So I just need to make that point pretty clearly. Turning to other commodities now, copper still on the increase and nickel also. So both commodities had a very good week. It was partly currency because we saw the US dollar went down, but it's partly underlying demand, which is surging for good fundamental reasons. Now, generally, with copper going up so strongly, that's mostly bullish for equities because nearly every copper bull market in the last 50 or 60 years, on what I've seen, equates very closely with a strong S&P. And that's exactly as you would expect it to be, because copper does well when the global economy is expanding. And when the global economy is expanding, then stocks generally tend to do well. So there's a very strong correlation there, and that's another support for this current trend that we've got in America and around the world in stocks. Now, crude oil, West Texas Intermediate, still pushing up higher, almost to $60. We've got a reflation trade that's in full swing. But look, the outlook long term for the energy sector you'd have to say, particularly for fossil fuels, is pretty clouded. And I heard just a couple of days ago that Shell, which is obviously one of the world's energy giants, sees continuously falling oil production from here on in. So, that's how the majors of the industry are seeing it. They're seeing it that it's an industry and a sector in decline. There's the spot copper chart, so you can see we had a real surge in the last week. And there is copper on a 5-year chart, just to give you a better sense of just how strong this move has been from the lows that we saw in March of last year. So we've gone from just over $2 a pound, and now we're about $3.75. So a very strong run in copper. Nickel also coming off those March lows has gone from $5 a pound to about $8.50. So great strength in nickel. Wrapping it up, investing today has a lot of uncertainties, and it's about stacking the odds in our favour. If you're not doing that, then you're probably going to be left behind. There are so many things that are stretched. Equities are stretched. Interest rates are stretched to the downside, and therefore the bond market is highly stressed. We've got to have probabilities firmly on our side, because there are going to be pullbacks, there are going to be corrections, and in coming years there's probably going to be the odd crash as well, like we saw last year. So you've just got to have probabilities on your side, and hence we'll go all the way back to the start of this video, and that is you've just got to have the probabilities. You've got to move away from conventional thinking about how things should be. Focus on the megatrends, because that's where the growth is, and that's where the certainties are, or near certainties. Only enter these megatrend stocks on meaningful dips. So again, just another layer of stacking the odds in your favour. Don't get greedy. Take partial profit on well-defined reversal signals. Turn it into a very repeatable process that is unemotional as you can make it. Now, portfolio analysts last week covered a lot of good ground. There was a couple of new additions to one to the 10-bagger portfolio, and one to the enduring growth portfolio, which is bigger stocks, longer term. And there was plenty of chart reading education as well. I think that was very very strong on that area. And of course, the general portfolio reviews. So that was portfolio analysts last week. If you've not taken the $1 trial for 2 weeks, it's well worth doing, because there's just so much good educational material in there. So that's it for this week. If you would like more information, there's my website address, and also an email if you wanted to contact me. I I'm sure it'll be another fascinating week, and probably no more so than with Bitcoin and other cryptocurrencies. I'll leave it at that, and I'll be back with you next Sunday. Cheers.